Natural gas futures are trading quietly at mid-session Wednesday, with bulls and bears locked in a standoff near a key technical level. U.S. output remains near record highs at 106 billion cubic feet per day, though recent softness in production has offered prices some short-term support. LNG exports are steady at 15.2 billion cubic feet per day, while power demand is climbing, with electricity generation up 1% year-over-year in the week ending September 6. These demand-side supports are offset by bearish pressure from the EIA's latest storage build, with tomorrow's injection expected to run about 9 billion cubic feet above the 5-year average, pushing inventories to roughly 7% above seasonal norms. Looking ahead, the next 3 reports are seen as bullish, but much of that may already be priced into the recent rally. Traders will likely wait for fresh signals in the storage trend to determine the next direction for prices. Meanwhile, weather remains a key market driver, with hotter-than-normal conditions projected through the end of September. Analysts point to lingering heat across much of the U.S., sustaining power burns as cooling demand stays firm. Daytime highs in the 80s and 90s, with triple-digit temperatures across the Southwest, are propping up cash prices and underpinning the recent rally. Still, overall national demand is expected to hold at moderate levels through September 21, which could limit additional upside unless forecasts shift toward even hotter conditions. With output easing, power burns firm, and weather lending support, the near-term bias tilts cautiously bullish as long as prices hold above the $3 pivot. A decisive push through $3.20 would reinforce that view, while failure to clear resistance could draw sellers back into the $2.90 to $3 zone. Meanwhile, downside risks remain, as late summer and early fall heat waves have been absent across much of the U.S., keeping cooling demand in check. The bigger question now is whether the global economy slows. Natural gas often tracks electricity demand, particularly during periods of heavy industrial use. If industrial activity weakens, power consumption falls, and the knock-on effect could weigh further on gas prices. Additionally, bulls can't drive prices endlessly on expectations of peak demand in December-February. If winter forecasts fail to deliver colder conditions, prices could just as easily retreat during that period, a reminder of why this market is often called the widowmaker. I have a sense that large speculators may take advantage of this setup, knowing that many traders are already piling into long positions. Caution is warranted. Think twice before committing significant capital to the natural gas market heading into year-end. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.